There is a $2.5 trillion corner of the financial system that does not trade on any public exchange. There is no daily price, nobody marks it to market every morning, and it has never been through a real economic crisis. Until now. In 2026, the cracks are becoming impossible to ignore. It is easy to write off the phrase private credit as something that only matters to people at hedge fund conferences. But this money does not stay on Wall Street. Private credit funds the small and mid-sized businesses that employ roughly 65 million Americans. It is the direct financing keeping the lights on at the regional manufacturing facility. It is the cash flow driving national logistics networks and the capital expanding regional healthcare providers. For thousands of these companies, private credit is their only available lifeline. If the money stops flowing from these funds, thousands of those companies could lose access to the loans that allow them to expand, make payroll, or stay open at all. The modern version of this market was born in the aftermath of 2008, when traditional banks faced dramatically stricter lending regulations. They had to pull back. That pullback left thousands of mid-sized companies without a reliable way to borrow money. A massive funding gap opened up almost overnight across the American economy. Private credit funds stepped into that gap. They raised money directly from institutional investors and lent it straight to these stranded businesses, negotiating the terms entirely in private, with regulators mostly staying out of the way. For a decade, this arrangement worked perfectly. But that bridge was built in an era of 0% interest rates. It has never faced a true economic stress test. The first point of friction comes down to the structure of the debt itself. The vast majority of private credit loans are issued with floating interest rates. This chart shows the benchmark rate, SOFR. Starting in 2021, it spiked from 0 to over 5%. Because rates float, interest costs went up automatically. For every borrower, required payments doubled or tripled almost immediately. Companies that took on debt when capital was free are now looking at mathematically impossible monthly obligations. They simply cannot generate enough cash to cover the new interest expense. When a borrower cannot afford those massive cash payments, lenders offer a mechanism called payment in kind, or PIK. With PIK, instead of paying cash, a struggling business takes on more debt. The overall balance grows. Yet investment funds report this uncollected debt as income, paying real cash dividends to investors based on interest they never actually received. Investors are looking at their statements and seeing consistent cash returns, entirely unaware those returns are generated by borrowers quietly falling further behind. If a publicly traded company gets into financial trouble, you see it instantly in their stock price on a public exchange. Private credit loans do not trade anywhere. There is no independent daily market price to check. Instead, these funds rely on Level 3 accounting. This means funds use internal models to decide what struggling loans are worth without independent verification. Because of this opacity, the official headline default rate looks stable at under 2%. But when analysts dig into selective defaults and restructurings, the actual default rate surges toward 5 to 8%. This creates a severe timeline problem. There is a massive maturity wall of heavily leveraged loans coming due through 2026 and 2027. Borrowers need to refinance, but the current math simply does not support it. The underlying structure is buckling as this debt comes due, but lenders grading their own homework keeps the true damage completely hidden. To accurately assess this risk, we have to look at the institutional defense. Major banks maintain that the fundamentals of private credit remain broadly healthy and that any acute stress is strictly isolated to poorly managed companies. Their strongest point is structural. The traditional banking system is not directly exposed to these specific loans in the way it was to mortgages in 2008, severely limiting the risk of a global contagion event. Base case projections from economists estimate roughly $100 billion in total write-offs. That equals roughly 0.4% of US GDP, a painful number, but one the system can absorb. The optimists see a contained problem with absorbable losses. But global financial regulators have openly stated that the data quality is too patchy and the market is too dark for anyone to actually verify which side is right. If the lenders tighten their belts, the impact will immediately hit the real economy. Viable businesses, from logistics firms to regional healthcare providers, will face a credit vacuum, forcing them to halt hiring, cut wages, or close their doors. And the financial losses will not be contained to institutional billionaires. Pension funds, insurance companies, and ordinary retirement accounts have aggressively bought into private credit over the last decade. everyday workers are unknowingly holding the back. This means a crisis here does not look like a sudden, spectacular collapse on the evening news. It looks like a slow, quiet starvation of capital, distributed silently across millions of American jobs and savings accounts. The tidal wave of private credit defaults has not crashed yet. But the warning signs are already pulling the water away from the shore, and that is when you need to pay attention.